Hi there, Adam Gower here again. Thanks for joining me. Appreciate your coming along to check out this episode on loan to value and loan to cost. Now, the way that it works when a sponsor goes out and buys a piece of real estate is that they will be financing it with two key components of capital. One is going to be debt that they're going to get from the bank, and the other is going to be equity that they're going to be asking you for. Now, debt, when it is placed on the property, is never these days going to be 100% of what the sponsor needs. If it were, then they wouldn't need your equity, right? So the way that the banks determine how much they're going to lend to a sponsor is by using one of two ratios. And those two ratios are loan to cost or loan to value. And be sure to go to leadersofthecrowd.com/small change, where you can download a list of the top 10 things that you need to know when looking at real estate investment contracts. All right, so let's take a look at the small change website over here. We're going to go to completed projects and scan down to Benning over here. And when we click on Benning, we will have a look all the way down here to about the finances, and we'll click on show more. And when we zoom in over here, we see these two concepts, loan to value ratio and loan to cost ratio. Okay. Now, the loan to cost is the amount that a lender will lend to a sponsor that is a proportion of the total cost of the project. And the total cost of the project is going to include the purchase of the land and any improvements that the sponsor may be putting on the project. And that could include fees and soft costs being architectural fees, etc., etc. Loan to value is a different ratio, because now what the bank is saying is, what is the ultimate value of this property? How much shall we lend against that? And so that's going to be a very different number. And of course, in theory, the value is going to be higher than the cost, right? So you might expect that the loan to value ratio would be higher. And indeed, in this project, you can see that the loan to value ratio is 75%. And the loan to cost ratio is 70%. And a bank is going to be looking at both of those ratios to make sure neither one nor the other goes out of whack. All right. And importantly, the more debt that you have on a project, the higher the risk that the project will fail. Why? Because if the borrower fails to pay to the lender what is agreed in the lending documents, in the loan documents, the lender will retain the right to foreclose on the borrower. So the more debt, the higher the chance that the borrower will stop paying on the loan and that the lender will take the property back. So you want to be looking for projects that have lower relative loan to value ratios and loan to cost ratios, okay? That's it for today. Thanks so much for being here. Don't forget, go to leadersofthecrowd.com/small change for more information on this very interesting subject of real estate investing explained. I'll see you in the next video. Thanks a lot.